Hello everyone and welcome to Mango Monkey Learns Money. In today's video, we will explore the concept of portfolio diversification. Portfolio diversification is a concept that comes up quite often in investing and in wealth creation. The idea is that you do not want to put all your eggs in one basket. You want to spread them out so that if one basket doesn't do well, you still have a few other baskets which do well. Kevin O'Leary diversifies like crazy. He never puts more than 5% of his money into one particular stock, which is very sensible advice. But what I do not quite agree with is that he said you should never put more than 20% of your money into one particular asset class. He recently said this to Graham Stepham, who invested most of his money into real estate.
I never let one asset class ever become more than 20% of my net worth. Clearly, real estate still remains more than 20% of your net worth. One of your goals should be over time is to make it, to get such a broad portfolio in your net worth that real estate's only 20%. So if that asset class really has a hard time, it can't take you out of business.
Got it.
So what is an asset class? According to Investopedia, an asset class is a grouping of investments that exhibit similar characteristics and are subject to the same laws and regulations. Historically, the three main asset classes have been equities, also known as stocks, fixed income, also known as bonds, and cash equivalent or money market instruments. Now, an asset class also includes real estate, commodities, futures, other financial derivatives, and cryptocurrencies. I do not personally quite agree with Kevin O'Leary. I would rather spend my money on something I know very well, like stocks and real estate, rather than venture into commodities or cryptocurrencies. I mean, I don't even know how those things work. If I can only dedicate 20% of my time learning about commodities, I will not know it as well as if I dedicate 50% of my time learning about stocks and another 50% of my time learning about real estate. Now, before you forget, please remember to learn how to smash the like button for the holy YouTube algorithm. My preferred diversification is 50% stocks and 50% real estate. At the start of my wealth creation journey, I will probably have more stocks compared to real estate because stocks are easier to buy. I can buy fractional stocks with as little as $1. To buy fractional real estate, I will most likely end up paying a lot of fees to the management company who issues the investment product. Towards the end of my wealth creation journey, I will also have more stocks because I do not want to have too much leverage and too much debt when I already have a few $1,000,000. I do not need all the stress of managing my debt. Real estate typically only works out better than stocks if I leverage my position with debt. On a related note, Kevin O'Leary also said that he will never invest more than 20% of his wealth in one particular sector. I completely agree with this one. Sector means the type of industry. You may, for example, own 20 different retail stocks. Chances are that even though you are diversified into several different stocks, all your stocks can be hurt by the same predator. So you want to have maybe 20% of your money in retail, 20% in mining, 20% in financial services, and so on. Financial services and real estate are somewhat related, so if you like, you may reduce your exposure to banking and financial services companies if you also invest in real estate. I will end today's video with a quote from Andrew Carnegie. The way to become rich is to put all your eggs in one basket and then watch that basket. Which wealthy person will you follow? Let me know in the comments. All the best and I'll see you next time.